Hello, everybody. Good afternoon.
Hello.
Sorry for jumping on at a little bit of the last moment here. And let's see, do we have our speaker in the house? Yep, I see them. Probably more than one. I saw he invited a bunch of his colleagues. So if you're new to the REIC Club at Intel, the Real Estate Investment Education Club, welcome. If you're new, just say something in the chat so that I know that you're here. And we will welcome you, and it's good to have you here. I did notice today that the attendance was a little bit low, and so I was curious, did people actually receive the calendar invites this time? Okay, Glenn's shaking his head, yes.
Yes.
Yeah, I did.
Oh, it's always kind of suspect. Okay, good. I never quite trust meetup.intel.com because it doesn't give me any feedback. It just says message. So technical difficulty. The speaker is having technical difficulties. Yeah, hi, Glenn. All right. Let's see if we can unmute you, Mark. Doesn't look like I can unmute you. I can ask you to unmute. All right. So while our speaker is working on his audio situation, yes, is there a way for ex-Intel employees to attend this meeting? So this is a good thing to bring up. I've been looking at Facebook, and Facebook, first of all, I get a lot of people that really just don't want to deal with Facebook. When I say, oh, we've got our group on Facebook, they go, oh, okay, I'm not part of Facebook. And so I'm curious for your feedback. What would be the best way to get this email invitation out to you? And particularly if you are planning on leaving Intel soon, my current thoughts are simply to set up a Google Calendar and share the link to the calendar to everybody. And that way you would just have a calendar and it would be there. Did you say something, Glenn? Okay. So that's my current thoughts. It'd be just, really simple. You'd have a calendar, you'd be able to look and see what's there each week. And we'd probably send out, maybe I'd set up a Google form just to collect an email address that's either Intel or non-Intel. And, I would make sure that all the people are forwarded the invite. Post on LinkedIn. Okay, that's good info. How many people here would like to have LinkedIn? Let me see you type 1 into the chat. And then if you would like an email invite where I set up a form and just email you the event through like a Google Calendar, give me a 2. 1 and 2. Okay. And how many? Lots of 2s. Okay. And then how many people here are still you want that Intel invite that's coming through meetup.intel.com? Give me a 3. Okay, lots of those too. Let's get some 2s, 3s. It sounds like maybe I do have some software that lets me sync a Google Calendar in my Outlook. So maybe I will use that. And it sounds like sending out just an email with a Google meeting and also sending out the meetup.intel.com. Let's see, Glenn says, can doing this by Google Calendar replace your analytics in ERG? No, but unfortunately, for whatever reason, on meetup.intel.com, about a month and a half ago, all the analytics broke. I currently can't bring up any charts from meetup.intel.com that give me any statistics on the attendance for the club. And so right now, meetup.intel.com seems to be broke in the reports area. All right. Mark is here. All right, let me give a little bit of background here on Mark. Mark is a developer who lives up here in Portland, Oregon. And he and I chatted on the phone a little bit, and I got to hear a little bit about his story. He's going to be talking to you about his journey, one of his investments into the hotel space, and in particular, what's been going on just in the last few years and how that's affected his business. So I'm looking forward to hearing just some overall takes on the development business, and then some Portland specifics, because I know we have people in Portland. And Mark, welcome to the group here, and feel free to introduce anybody else from your company that you've brought along.
Great. Well, thanks for having me, folks. Don't do a lot of speaking about our company or kind of the work we're doing, but I think that this will be an interesting one just because we kind of have a unique story. We're a small bootstrap development company that's been around for 15 years, and we've done projects in all asset classes, mostly in the Portland area. We have a team of 6, so most of my colleagues have joined this call just to kind of find some reason to make fun of me later on after this thing's over. No, just to get some background on the company, because not everybody's been around for the 15 years we've been here, so it's kind of a good opportunity. And so I'll share my slideshow, and then there'll be time afterwards for questions. We have nothing to sell here, and there's no kind of angle. It's just like a lot of information, and it's kind of in the format of a business adventure story, which are the books I kind of like to read. So, hopefully you'll find it entertaining at least. And feel free to ask questions, I think probably towards the end. So let me share my screen here. And then I will start slideshow. Oh, sorry, folks. Hold on. Technical difficulty. There we go. Okay. Well, happy Friday the 13th, everybody. So this is a business adventure story of Greenlight Development. My first real estate job was working for a community development corporation, which is a not-for-profit that develops affordable housing in northern New Hampshire. After that, I got a job at a senior housing developer that had a national focus, and I was about 25, and the amount of exposure they gave me was unbelievable. We worked on projects all around the country, and I probably had 12 to 15 going at one time. And this is a company called Sunwest. People might have heard of them because Sunwest went under because the CEO was engaging in criminal activity. This is the largest senior housing owner, operator, developer, vertically integrated firm. And I was there during a period of time of just tremendous growth. The reason why Sunwest went under was that there was multiple investors in multiple LLCs, and the CEO began commingling funds from one entity to another to fuel growth. So when one asset wasn't doing as well, brought funds from others. So I was in this environment of just deal processing. I wasn't involved in the investor side of things. I just always knew there was money for these. And the amount of exposure they gave me early was unbelievable. And there's some lessons learned there.
Hey, Mark, really quickly, could you put yourself into presentation mode? We are looking at your PowerPoint app right now.
Oh, that's funny. Okay. Gotcha. Let me just, let me see what I can do. Let's see.
It might just be, if you look at the lower right-hand side in PowerPoint, there's a sliding zoom bar, and then just to the left of that zoom bar, there's a little icon that looks like a TV. I think all you have to do is hit that, and that'll put you in presentation mode.
Okay, friends, sorry. This is like a bunch of tech people, right? And me being a real estate guy. Oh my gosh. All right, one second here. Can you, because I'm working on 2 screens here.
Mo tech people, mo tech problems.
Yeah, I think maybe that what I do here, sorry, friends. Is it easier if I get out of presentation mode and go like this? Can you see me?
Not yet. We see you, but not your screen.
Got you. Thank you. How about now?
Here we go. It's starting. That's
okay.
Better. Much better.
Much better. All right. Well, Let's let me go to presentation mode right now and see if it works again. Did it go back to what it was before?
Yes, it did.
Okay, got it. Then what I'm going to do then is
swap screens.
I probably need to swap screens, huh? Okay. So
Yeah, might be. I'm okay with it like this if other people are, but it might be that you need to go down to Zoom and hit and reshare and then use your other screen.
Okay.
I think you can swap in presentation view too, but honestly, this is big enough.
This is fine. Yeah.
It's good. Sorry, folks. This is you know, make fun of me all you want. This is how it goes, I guess. All right. So we're just going to work off of this and see if it all works out. So I think the challenge with this is that I won't allow things to appear as I had hoped, but that's okay. We'll just work with it. So let's just go with this. So long story short, I left here before all this went down and found interesting that a few years ago, Trump commuted this gentleman's sentence. So I kind of, it was a unbelievable early entrance into fast moving real estate that I think was done at a high volume and probably pretty irresponsibly, or very irresponsibly. And where I went from there was a job at a large development company called Opus Northwest. And that was kind of a massive slowdown, white slipper kind of real estate development environment. We did some very large projects in town. One of them, we were just finishing up when I started, was Bridgeport Village, which most of you have probably been to or heard of. And then we moved from there was to do kind of larger mixed use projects. And I was really the development associate and then development manager on some massive projects. One of them was this project Lad Tower. And this is a project that we were under development in, and it was a 220 unit condo at 21 stories. And this is when the condo market was going away. In order to start construction, we had a 50% pre-sale threshold in the condos, and the market just went away. And so we were stuck with this big wide building with giant floor plates for condo. And we changed it while maintaining the actual exterior design review to a 332 unit tower at 23 stories. So it's kind of like changing a tire going, 60 miles an hour in a way. And so this is something that I had the privilege of being, very involved in. And around the exact same time as LAD was gestating, we sourced a project in Northwest Portland across from Cooch Park called Park 19. And this is a 101 unit project. Now, the reason why I put these two up is that they, around the exact same time, similar market, had drastically different outcomes. LAD, we built for 100 million. Our financial model had a sale at 130 million. We had $80 million in debt, and the bank took it back for $80 million in debt. This is right around the 2008, kind of financial crisis. So think about that, right? And the challenge was that LAD took 2 years to entitle and get the design right, et cetera, and change it from condos. And then it took 2.5 years to build. Park, 101 units, Alphabet Historic District, cost us, same time period, $25 million to build, and we sold it for $30 million. So around the same time. So Opus Northwest is no longer around. The entire staff got laid off. And basically I was on my own to start my own development company in 2008. So I had, in retrospect from now, the timing was excellent, but at the time it was petrifying. But I didn't really want to do anything else but be a real estate developer. I did look at other ideas, but this thing I was good at, I understood it. Now, you know how in a real estate development project, there's probably 20 different experts that you help coalesce around a shared vision or one's vision, between finance, accounting, legal, engineering, architecture, marketing, any one of those kind of specialties that coalesce in a development project. Personally, I'd probably be awful at. For some weird reason, I'm able to do them all without going through a lot of depth in each subject matter, which makes me kind of I guess the hope is I gain depth over time. But anyway, this story brought something to me, which is Park. Why did it do so well relative to LAD? What, right? Same time, should be similar economics. And really it came down to cost of delivery. High rises are very expensive to deliver. We were able to preserve margin with a smaller project. Now, the other reason why so is it was smaller. So my thesis was, can I build wood frame projects like Park 19 and make them smaller and have less exposure and go? So the thing about working at the senior housing company that was really surprising me about the senior housing industry in general is that it just works based on a net operating income model, right? Where the rents that you charge minus the expenses create net operating income. And the more NOI you generate, the more valuable the asset is. What was very difficult for me to conceptualize was that these were seniors, right? So you had a captive audience who were, relatively immobile with a high amount of operating expenses that go into the asset. So all the customers and the owners of these buildings, the customers and the owners of the building had completely divergent priorities. Seniors wanting more security. So the first project, I had a friend who's an architect in town named Bing Sheldon. He's since passed. And he came with this idea. He had a bunch of his friends and he wanted to build a building for his friends. And we found a specific program for a senior housing cooperative. These things were all over the Midwest, where the actual residents of the building ended up owning shares in a co-op that owned the real estate. And so we grabbed it and went with it. We got a site in Northwest Portland under contract. And it was an 83 unit project, and we pre-sold to these seniors half of the units in 2010. I focused all of my energy on this, and the project failed. And the project failed for a number of reasons. And the main one was my track record. And my track record personally, right, as a developer of a new company, and the ability to access capital due to the lack of track record. So that was this is a very tough moment for me and my business, because I didn't, first project failed. This is 2 years and basically all the money I had. Around that same time, I had a friend who's a developer, a gentleman named Chris Nelson. He's a principal at Capstone Partners. They weren't doing anything either in 2010. And he kind of put his arm on my shoulder and he said, "Hey, listen, Mark, why don't you just come office with us? We're not doing anything right now. It's the doldrums as real estate development goes. It's the worst time. Let's see what we can put together." And Chris had track record. And so we ended up into a partnership where we just had this run of real estate projects, mostly urban multifamily projects close in Portland. When I left Opus, got laid off from Opus, I left this project as a drawn project at that company. Opus had, it was a new pursuit that I brought in, and this one we went on a contract on. 2 years later, somebody else bought the site. I found access to that property owner, contacted them, had all the old plans that I'd worked on, and brought this into fruition in 2010, 2011 through a partnership with Capstone. And it was an enormously successful project. And the main reason why it was successful was because when it delivered, this was the article in the front page of the Willamette Week. 2012 in Oregon, in Portland, was the worst time to be a tenant because nobody had built anything for 4 years. There was nothing. The financial markets were frozen for there was nothing. So our timing was really good. And so I kind of ended up realizing that timing was actually even more important than location. And around that time, between 2012 and 2018, we doubled down on multifamily, market rate multifamily, and just did a lot of projects. And most of them, I'd say about 60% of them were in a partnership with Capstone. Greenlight, we kept our own business, and other developers, other investors decided to give us a call and try to work with us. And so we ended up kind of, growing a big, growing a lot during that time. Around that same time, we ended up getting an old school. I'm going to kind of move this because the presentation is a little bit weird right now, but we ended up getting an old school under contract. This is the former Waverly Children's Home, an 88,000 square foot old facility that housed troubled youth in Oregon. This was had multiple different contracts with state agencies, been around since the 30s, and had been empty for 4 years. And time, one of my friends was a home builder close in Southeast, and through 2012, it's hard to remember those times, but there was nothing happening. There was still nothing happening, and this guy was selling spec homes close in Portland for a profit. And I just thought it was amazing. How was he doing that? So we ended up getting this school under contract, demolishing it, and building 19 homes. And what we did uniquely is if a standard Portland block is 50 by 100, this site was 400 feet by 200, right? So we could get the grid pattern in for single family homes. The challenge with the Portland block is that if anybody's seen these blocks, is that you don't really get much of a backyard. So what we did is something a little bit creative. Is we took 4 homes, really 8 homes in the middle, and created shared access easement 25 feet, and created really a community. And so this is and then we built our house here. So at that time, I got my real estate agent license and sold all the homes, and we just put together custom build packages for everyone and kind of finished full build out into 2015, 2016. And it was an enormously successful project. And what defined success for me was we made some money, the neighborhood's enduring, and none of my neighbors hated me. So that was cool, right? So that was kind of for me, the biggest bar is like, I'm going to live here. So, so it took a lot, and it got done. And it's a great place to live. And it's a great place for my kids to grow up, and, between the ages of 5 and 8, 5 and 10. So anyway, so that was a great one. And we ended up kind of continuing to do a lot of single family homes during that time, while at the same time we were doing the multi. So it was a pretty busy time. The single family homes for me were a way to kind of generate enough margin to be able to have a meaningful investment position in the apartments. So that's kind of how that being able to be in both was helpful, because the period to start and harvest a single family home sale was about 2.5 years, and 2 depending. And a lot of these apartment projects, they take 4 years to actually realize. So there's a time associated with these. So we also ended up doing a 14 home subdivision on Mount Tabor as well during that time. So then kind of want to shift a little bit to, we've done some interesting exchange, tax strategy ideas, exchanges. One is, did you folks know that you could buy real estate with a Roth IRA? So you can. And what you can even do is you can even option and sell real estate with your IRA. So we did that with just, one lot where we got a property under contract in the name of the IRA. And then we ended up actually just flipping the contract in the name of the IRA, and a builder came in and built this on it. So it was a way to really go from very little into an IRA into a lot. So that was kind of one, kind of wild thing that came up. Also, I'll kind of, the sequence of the slides is awkward right now, but basically, if I'm going to rewind for a second and you bear with me on this ugliness, we ended up building this really simple townhouse and sold it. we bought the lot for very, very little, sold it and created a lot of value. And pause for 1 second, because then what we did is we ended up exchanging into this beauty, which is folks in Portland may know Green Drop Garage. At the time, my friend Farhad started this company, Green Drop Garage. And first of all, there's lots of different random ways to make money in real estate. This is just interesting. So Farhad had a business he wanted to start. Now, he actually had one other location. He was trying to grow it. He didn't have money to buy a building. So I went to Farhad and I said, well, let's go find a building. So I bought this building with those exchange proceeds and entered into a 10-year lease with Farhad and bankrolled everything with a pretty high rent. We bought the building on a seller note from the gentleman who ran this garage. He was a chain smoker named Kevin, super nice guy. Basically on a seller note, converted this into a Green Drop. Farhad's had been a tenant for 6-7 years, always paid rent, great guy. And he wanted to buy the building. So he said, great. We figured out a price. And well, then we ended up exchanging into this. So this is a 18,000 foot retail center in old Happy Valley, city of Happy Valley. The library's kind of nearby. If you folks know of it, there's a daycare in it and several other tenants. And one of the reasons why we got a good deal on it is that we had one tenant, the Snap Fitness, vacate. And so the thing was half empty. And now we're out to leasing the balance. It's about to finish up. But the other thing that's pretty cool about this site is an active project for our company right now is all this extra land. So at this point, we're dividing this land. And we basically, at the end of it, have free land to build a 19-unit apartment building on it. So what's just kind of really cool is if you kind of make the right plays early on, you can turn, I think in my case, literally a $50,000 investment in the townhouse project, because we use a lot of leverage on it, into owning an asset like this over time. So the other property that we also exchanged into it, my wife's a chiropractor. And so we bought this building on Woodstock, which we also sold as part of the exchange. And we bought this building as an SBA loan. I think we bought it for about $350 and we sold it for $850, 7 years later. So that also entered into part of the exchange process. And then the SBA loan, you folks may know, is the SBA loans are pretty high lever. So one of the tools that we use here is debt, right? So we've been very successful in using debt, but it's not without its risks. And over the years, especially as we've grown, I've been pretty aggressive with trying to maximize the amount of leverage we can put on assets. My mentality's changed now that we're, kind of through the gauntlet. One of the ways that we were able to attract, high lever debt is in an asset that we built called Home. And if folks know where this is on the Selwood Bridge. If you're coming in to Selwood, driving into Selwood, it's on the right-hand side. It's right on the Selwood Bridge. You might look familiar now. It's a pretty high-profile looking project. We got this site under contract before the new bridge renovation. So HUD exists for a lot of different reasons. One of them is to provide basically Section 8 rent coupons for people to be able to rent. In addition to that, they have a number of different loan programs that are complete brain damage to access. It's like going to the DMV for a loan. I mean, it's tough. But there's several advantages. This particular HUD loan is a 221 D4, if you have the patience to look it up. And basically, HUD actually isn't the lender. HUD guarantees the note, and you have a third party who's the lender. So it basically is a way to get a federal guarantee to your lender. Now you have to jump through 3 fiery hoops and wait 2.5 years to get it done, but you can get it done. And that's what we did. Some of the fiery hoops are literally a 2-year process with HUD to get the approval. And you have to build your building with prevailing wage. That has about a 10% increase in cost for us. But the advantage also is that you have a non-recourse loan, and we got about an 87% loan to cost. So if you can put 10 to 15% down on a building like this, it creates for a really strong investment, because the few people who are lucky enough to be your partners in this thing end up owning it with virtually no one else. Does that make sense? It's a little bit like getting permanent financing a construction start. It's a 40-year amortizing loan, and it's worked out great. Now, what's challenging about it is if HUD takes 2.5 years to actually close, just like the LAD tower example, the market can go away from you. It can go, it can go either way. Now, fortunately for us, the market was roaring during that period and interest rates were low, but that was a scary 2.5 years because we didn't own the property during that time. So we couldn't come up with the $2 million to buy the property without it being fully HUD approved. So we had to option it. And so every kind of few months we paid an option payment. HUD took so much longer than we thought that the option payments ran out, and the seller was about to refuse to allow us another option. And we would have had the property, we would have sunk all of our architectural work, all of our advanced payments, and the thing would have extinguished. So fortunately, we found an environmental problem with the site. So the problem, the prior owner was an industrial use, and he leaked solvents into the soils, which made the soils difficult to develop. And so he was kind of stuck with us through this DEQ process. And of course, we made the environmental issue sound like such a much bigger deal than it actually was. We got through it. We just had to excavate some soil, but it took some bureaucracy with Department of Environmental Quality, which helped buy us more time. And if this site didn't have an environmental issue, we wouldn't have built it. We would have been out. But the seller was kind of hitched to us for that longer period. So anyway, the asset's performing really well right now. It's a 120 unit project. It's got underground parking, and we're really really happy with the outcome. We still own it along with our investors. And we're feeling really good about the interest rate on this asset relative to where rates have gone. We stopped building assets like this in 2018. So the reason is that we were noticing that the costs of construction were spiking so quickly that the cost to build were actually equal, all-in cost to build were equal to the value that assets were selling at to institutions. So if this asset cost, today's numbers, $34 million to build, $35 million to build, the asset was actually selling for that amount of value. So for me, there was no reason to be in multifamily anymore, because the values of these assets were, why take all the risk, right? So we shied away, but we were still looking for something to do. And this is as we got to like 2018, 2019. So what we were looking for were properties that created more yield. So it's an example of a property that would create more yield: a hotel, a co-work space, anything that kind of became less strictly real estate and had more of an operating business component on it. It would create more yield. So we kind of decided to head on in and do that. And so what we did is we ended up building not just any hotel to create more yield, but one with bunks just before COVID. Now bunks create even more.
Hey, Mark, one thing I want to make sure you also get to go through the COVID period, but get to what your thoughts on the current market are, and how you're positioning yourself in the current market.
Yeah, that'll be right after this puppy. Yeah, for sure. Okay. Well, yes, I will. So And so just for feedback, Daniel, should I be am I moving a little slowly on this stuff?
I feel that the tempo could be a little better, but I'm enjoying listening to it.
Yeah. All right. Cool. So we built this. We entered it. We built it and opened it 4 months before COVID hit. So we opened and closed this hotel twice. And this hotel, folks might know about it. It's on the corner of MLK and Burnside. Here we go. Historic Registry, PACE loan, which is a very unique property tax loan program. We were the first in Oregon to do it. And it has been the most difficult project of my life, but we're finally on the other end of it right now. We were an early adopter of crowdfunding. And this was an asset that was capitalized in part by our friends at CrowdStreet, which is an Oregon startup that now they moved to Austin, and they're a pretty strong real estate platform. So this asset has 120 investors. We just finished a capital call and orchestrated that with 120 investors. This has been the hardest thing I've ever done. But we still own it. And it's our investors I think have been very supportive given the circumstance. It's like who could have spotted COVID. So we do like events here. We do we rent out hotels to group the entire hotel to groups, etc. Okay. Another COVID difficult project is cowork. Look at the density of this asset. So really, my idea was let's stick more people into denser places and be able to kind of feed off of that dense environment and create more yield and actually be able to put more money into quality high-end design. That was this theory. So this is an asset. We're an investor in Central Office. This is an asset in Sacramento. It's an old office building that we purchased and renovated and put a rooftop deck in. This rooftop deck runs events. So we're thinking, oh, Sacramento, great. Lots of state lobbyists, et cetera. San Francisco California is a giant market. What we learned was that the entire office market was dependent on when the state requires people to go to work or not after COVID. And so still downtown Sac is ghost town, really tough asset to own. We ended up going through a recapitalization on this project, which saved us, worked out well. But here are just some images of what this looks like in the end. Okay, so what are we doing now? How have we reacted to the market now? What's happening? We are almost exclusively developers of affordable housing at this time. And we've turned ourselves into one of the larger affordable housing developers in the state. Over the last 3 years, we've built our business around this. If folks are curious about homeless issues, there's a fantastic article in the Atlantic, just this last issue. Highly suggest reading it. And some of the key points of this article are pointing to the homeless issue is really a housing supply issue. It's not, if we look at mental illness and drugs, those are certainly an issue that contribute to homelessness. But they are actually not the main cause of homelessness. Markets like Utah, Alabama, Colorado, Vermont, Kentucky, West Virginia, Delaware, Wisconsin, they have some of the highest levels of drug use and mental illness and some of the lowest homeless rates. So it's not quite correlated. You would think it is because that's what's in your face more. Eco Northwest did a really interesting article for the Oregon Community Foundation in 2019 about Oregon specific issues around homelessness. Very interesting article. And Their article basically, and it's more than an article, it's a white paper. It basically points to a supply issue in our market that creates homelessness. And those supply issues are associated with less, well, look at this thing on Division Street. This is one of our projects. There is so much NIMBYism that has filtered its way through, and prohibitions that have filtered its way through in a lot of coastal cities, which have also spurred on legislation really making housing difficult to deliver. And all that's done is it's driven up cost of delivery, because the financial markets, developers have to go through more risk to get it done, and it ends up making the assets cost more. So if you go to a market like Houston, where there's just a lot of housing production, there's not really much of a homeless issue. The Eco Northwest article, I can keep moving, but basically right now we're doing, this is our portfolio right now of projects. This is stuff that's under construction right now all over Oregon. And we're loading up a new round for completion for 2025. Our target for affordable housing is mostly family-oriented housing at 60% median family income or better, or lower. And so, yeah, that's what we're doing. That's kind of the end of my presentation. I mean, we are geared up to do a lot more production in affordable housing over the next several years. We're trying to move that target from 60% to trying to hit workforce housing, which is 80 to 120% median family income. One of the reasons why we've been able to pivot into affordable and doing other things is that we're a small shop. We're considering starting a construction company, and we're just getting after it. I mean, I'd say we're lucky to have made the pivot to affordable right now. My friends who are developing market rate are not working on much right now. There's very little new construction activity happening.
Hey, so Mark, I wanted to ask you a little bit about the pivot into affordable housing. There's definitely a need for it there, but what about support from financing companies and from the state? What has happened there that has enabled your business plans?
Well, the state had we are using the low-income housing tax credit model, federal low-income housing tax credit model, where based on state demographics, the federal government issues tax credits to each state, and the state then has competitive processes to award those tax credits to projects that fit their qualified allocation plan, and then we win it through a competitive application process. The federal government and state government have over the last 3 years increased allocations towards housing, and particularly in Oregon, housing is as you all know, a giant issue front and center politically. So we're anticipating more money in the state level towards affordable housing than ever before over the next few years.
Okay, and just for people that want to look that up, that's Section 42, low income housing.
Yeah, low income housing tax.
LIHTC.
Yeah, LIHTC. Okay. The financing mechanism of these assets is relatively complicated. The applications are very competitive. There's two different flavors of tax credits, a 9% and a 4%. The 9% are really kind of targeting more acute populations with deeper subsidy. The 4% are more around family-oriented housing, which is what we're targeting. Mm-hmm. And it's a very, very nuanced, very specific kind of niche.
Are you getting a lot of your equity funding from larger equity partners, or are you going out and raising from individual investors?
With the exception of our COVID casualties, we went to investors, right? And that was really, for me, unilaterally the most stressful component to it, because we were syndicating to individuals. And for me, I've really made a decision in the business to kind of not do as much of that, because it created so much stress, right? I mean, there's friends, there's family, there's a lot. With 120 investors in a hotel, So what we've been doing is partnering more with institutions. So the person that you're, kind of talking to is a real estate professional on the other end of the table that is sophisticated, and if the investment goes sideways, they knew everything, right? They knew what they were getting into. It's a much easier conversation to have. Now, on the affordable housing side, what's been really neat is that we haven't really needed investors. We've been able to self-fund all the development. And then when I say I haven't needed investors buy the tax credits that you get allocated. So the investors are large companies with a tax liability, and they're able to shave off their tax liability by 8, 10, 12 cents less on their tax liability. Those are our investors. What's interesting, though, is that rather than working directly with Chase Manhattan, Chase, for example, although they are one of our direct investors, we end up working with syndicators that go to several different companies with tax liabilities, put it in a fund. And so those syndicators are like Enterprise Community Partners, CREA. And so you're also dealing with a sophisticated affordable housing underwriter who's the purchaser of your tax credits. But other than that, we don't really have any investors on the affordable. Okay. Yeah.
Gene has a question here. How do you make money in affordable housing, and how do the margins compare to market rate apartments?
It's a great question. And in a market rate apartment, they're very different ways to make the money. So in a market rate apartment, you put up, let's just use a 100 million. This is typically how a big deal gets capitalized in the market rate. Let's say it's a $100 million project. Your loan's probably 60 million bucks. Okay. So you need 40 million in equity. 40 million in equity. So you go to an institution and raise 40 million in equity. Here's our building. Here's how you think we're going to do. Now, the investor says, well, how much are you putting in? It's 40 million. They say, we want you to put in 5 to 10% of that amount, just if you think it's such a great idea. So you have to put in 2 million bucks, 2 to 4 million bucks. And you ride right alongside that investor, your $2 million or $4 million with their 36 or 38 million. Once the investment performs over a yield threshold, then you end up getting a promote, which is a larger percentage, larger share of the pie. So the market rate returns as a developer can be extremely lucrative in a good market, and can be really could be nothing, or even worse, could be a loss of capital, right? So the market rate projects are a lot more subject to how your project does. You're on the sharp end more. The affordable projects, you get paid less, but it's a little steadier, right? So it's more of and your investor, think about this, your investor has shifted from someone wanting to make money to somebody wanting a return that is social. You like a return for the community, more housing stock. So an affordable housing development, or I should say this, a market rate development would earn a fee of about 5% of the project cost. And an affordable housing development will earn a fee of about twice that amount. But there's very little upside after that. And usually the projects don't pencil, as in they're more expensive than. So what you have to do is you have to basically defer your fee, and that doesn't get, and the rest of the fee doesn't get paid out for a 10 or 15 year period. So to answer the question simply, the affordable developments are a lot less lucrative than the market rate developments. And they require a lot of risk still. But for us, we're not in a spot where we need to be kind of, creating giant margins here. We're really in a spot where we're trying to build more housing.
Smith is making the comment, it sounds like it's not a cash flow game, but an equity play.
It's a fee game. Yeah, it's a fee game. It's like now there is some cash flow, but there are so many the cash flows don't really show up for a very long time, And for the affordable, you have to be set up to own it for a long time, because you have to be a fiduciary to your tax credit investor for 15 years. And so you have to manage the asset for 15 years. And where there is opportunity is after that tax credit investor goes away, you end up having an asset where you pay that tax credit investor off. And that's typically after 15 years when you'll start to see the cash flow. So it's like it's a long haul.
Can you describe some of the fees? There's some questions about what the fees are and what the structures are like.
On the affordable housing fees.
Mm-hmm.
Yeah. Well, I mean, similar to hiring a general contractor or an architect, the affordable housing developers, the state limits the percentage of fee, but it can be, up to 10%, it can be around 10%, depending on the size of the project, 12%, depending on the size of the project. The bigger the project, the lower the percentage fee is allowed. The smaller the project, the higher, because you can imagine it's all a similar amount of work, just relative to the amount you're producing, right? And generally half of that fee is not paid during the construction period. Well, very little of it's paid during the construction period. It's paid really after your building's complete. And then the fee is paid out of cash flow. So you get 50% of the fee typically. Let's say the fee is $1 million. Half your fee typically is given up and paid during the 15-year period that you're running the asset, because it has to be deferred. And then, so let's say you have $500,000 left. Typically you get 25% when construction starts, 25% when construction is completed, and 50% when the project's in a bow and it's completely leased and happy and there's a compliance period and it's audited. So the fees can be a little bit delayed, but remember, if you're starting a development project, you conceptualize the idea 2 years before you actually build. So it can be kind of it's a long play. You kind of, as an affordable housing developer, you have to be like ready for delayed gratification. Is one way to look at it. But we wouldn't be doing it if it wasn't significant, right? But the nuance is that in order to get to the project where it's able to be funded, you need to fund all of the initial development work. Not too different than that HUD loan example.
There's a question in the chat. First, really quickly, does your company manage other properties, ones that you don't construct? And then the second question is, why are you considering starting a construction company now?
Well, we have been hired by investment firms to do analysis for them, to do development management services for them as a third party. Really earlier in my career, we did a fair amount of that to help pay the bills. Right now, we don't do anything really for third parties, except if it's affordable housing. So sometimes a not-for-profit will come to us and say, hey, listen, we have this idea, we want to do this, but we need the technical expertise to execute on this. One such client is a not-for-profit called Bridge Meadows. Look them up, it's really cool. They do a multi-generational community of seniors and foster families in housing, and we helped them finish a project in Redmond very recently. A 9% low-income housing tax credit project. So we'll be like a technical execute for them in that capacity. Basically, the reason to consider starting a construction company for us is that our affordable housing work is this very replicable product. It's basically the same building with slightly different skin done all over the state. And so if we know our product super well, and our current contractor, who we're doing a lot of volume with, is so busy with their work, we need to bring on another contractor to help us. Or maybe we start our own. So, and that would be an opportunity to, pick up some more margin. And also over time, I think, be able to offer more affordable housing for less expensive. We might be able to actually push down margins and be able to deliver more volume, which is more on my mind. I mean, regardless of the flavor of the housing, my premise is that in Oregon and a lot of coastal states, it's just a housing shortage issue. We just want to be in a position where we're belting out housing and a production mentality at this time. And that could end up being market rate too. It probably will be market rate in a few years.
All right, Mark, we have about 3 minutes left. Is there anything that you would like to leave the group with here?
Oh, thanks for that. I mean, I don't know. If anyone has questions, feel free to reach out to me. I don't have anything like big and wise, to kind of end with. I just think it's maybe just kind of fun to share what we got going on. And
yeah, I've really enjoyed hearing, how you run your construction company and just, what you're looking at in the local market here. A lot of people here are from Portland, but California and Arizona too. It's interesting just to see the thought process behind somebody who's building affordable housing now.
Yeah. I would say around the housing, the more you look into it on the root cause of affordable housing, it's just a very interesting subject, at least to do a little bit of digging and research on the real causes of it, because there's a lot of misconceptions. And so anyway, cheers. Thank you for having me. Really appreciate it, folks.
All right. Somebody's asking, how do we get in touch with you?
Oh yeah, cool.
If you want people to get in touch with you, I since you don't do a lot with investors, I don't know if that's what you're looking for.
Cool.
But...
well, let me. I'll just put up my my little contact info right here. I don't know if people are going to see that. Probably not. I will.
Do you want me to drop?
Can you send an email, or I drop it in the chat maybe?
Drop your email. Yeah,
email and contact info. And by the way, we very likely will be doing projects that that we will be syndicating in the future. It's just right now just feels like not the time for it. But yeah, totally. I'll drop my contact info in the chat, or if you want to do it, great.
Oh, I accidentally just sent it to one person here. Let me send it to everybody.
And thanks for asking. Yeah, oftentimes we get calls from just people with their own real estate kind of stuff, and they just want like some advice. So I'm open for that too. So So anyway, cheers.
Right. Well, hey everybody, can you take yourselves off mute? And thank you, Mark, for coming in and speaking to us today.
Thanks a lot, Mark.
Thank you.
Mark.
Thank
you, Mark.
Thank you, Mark.
Thank you, Mark.
That's right, everybody. Have a great
Thank
3-day
you.
weekend.
You too.
And we'll be back here next week.